All right, welcome everyone. Today, we're going to walk through a concise executive summary of ITC's third quarter performance for fiscal year 2026. Let's just jump right into the key takeaways. So, let's start with the big news, the main takeaway for our shareholders. The board is recommending a very strong interim dividend of 6 rupees and 50 paise per share. And this, of course, is a direct result of the really resilient performance we're about to dive into. Now, you're probably wondering, what's backing that strong dividend? Well, it all starts at the top line. We delivered a solid 7.1% year-over-year growth in gross revenue, and that shows some real momentum, especially considering the challenging market out there. This growth is really the foundation for the strong profits we'll get to in a bit. Okay, so here's our game plan for this review. We'll kick off with a high-level summary, then we'll dig into our core growth engines. After that, we'll talk candidly about some market headwinds and our strategies to navigate them. And finally, we'll wrap up with profitability and shareholder returns. All right, first up, the executive summary. This is the 30,000-foot view of what was, I'm happy to say, a very resilient quarter for us.
So if you look at the key metrics here, what really jumps out is the consistent growth right across the board. It doesn't matter if you're looking at consolidated or standalone figures, we're seeing healthy year-over-year growth in revenue and, importantly, in profit. That consolidated profit after tax, up almost 10%, that's an especially strong result we should be proud of.
Okay, so what's really fueling these numbers? Let's peel back the layers and look at our core engines of growth to see exactly what's driving this success.
And this chart, this really tells the story. You can see our FMCG Other segment is just leading the charge here, with an absolutely outstanding 12.6% growth. That's backed by some really sustained momentum in the cigarettes business at 8.2%, and a very solid performance from our agribusiness, coming in at 6.3%.
Now, if we zoom in on the cigarettes segment for a moment, the key here isn't just about volume, it's really about value. Our strategic focus on premium and more differentiated products is clearly paying off. It's not only strengthening our market position, but it's also a crucial part of how we counter the ongoing impact of illicit trade.
And over in our agribusiness, our big strategic pivot to value-added products, or VAP, is showing some fantastic results. I mean, just look at this chart. We've seen a nearly twofold increase, 1.9x to be precise, in our VAP portfolio since Q3 of fiscal 22. This is a high-margin area, and we're scaling it successfully, which is great to see.
Of course, it wasn't all a walk in the park. We have to be clear about the challenges. So, let's shift gears and talk about the market headwinds we had to navigate this quarter.
You know, our paperboards and packaging segment in particular really faced a bit of a perfect storm. We had significant pressure from low-priced imports, which frankly subdued market prices for everyone. Add to that high wood prices, and then, to top it all off, severe cyclones that directly impacted our wood harvesting and supply chain. So, a lot to contend with there.
So, the big question is, what are we doing about it? How did we respond? That brings us right to our strategic interventions and outlook, where we can break down our action plan.
This slide really lays it out perfectly. Challenge on one side, response on the other. So, faced with that market challenge of cheap imports, our response wasn't passive. We've been actively advocating on behalf of the industry for things like extending the minimum import price and other key safeguard measures.
But our response goes beyond just policy. It's also about what we're doing on the ground. We're making long-term investments and upgrading our facilities and getting much smarter about plantation management. We're even using tools like satellite monitoring. All of these moves are designed to do one thing: secure our wood supply and make us more efficient for the long haul.
All right, so looking ahead, we see a mix of opportunities and challenges on the horizon. For cigarettes, we're gearing up to navigate a pretty unprecedented tax increase that's coming on February 1st. In agri, the game plan is simple: keep our foot on the gas and continue scaling that high-growth vape portfolio. And for paper, we're expecting and hoping for a welcome moderation in wood prices.
And all of this brings us to our final, and I'd say most critical section, profitability and shareholder returns. This is where the rubber meets the road, where we see how all our strategies and operational efforts translate directly to the bottom line.
And the headline number here is fantastic. Our standalone EBITDA margin is sitting at a very healthy 35.1%. This really speaks volumes about our operational efficiency and some very robust cost management across the business, especially while juggling commodity inflation. But what's maybe even more impressive is that this isn't just a snapshot. We've actually expanded that margin by 50 basis points compared to last year. This is a testament to our ability not just to protect, but to actually enhance profitability even when costs are challenging.
And so here we are, full circle, right back to where we began. It's this strong operational and financial performance that allows us to deliver this very tangible value, 6 rupees and 50 paisa per share, right back to you, our shareholders.
So as we wrap up this summary, I want to leave us with the key strategic question we should all be thinking about. Amidst all the global volatility and ever-evolving regulations, the real question is, how do we sustain this incredible margin expansion and keep driving growth across our entire diverse portfolio? That is the challenge we're excited to take on. Thank you.